In today's video, we are talking about a major drawback inside of the TSP that I don't think most people are aware of. Coming up next. Hey, my name is Mel Stubbs. I'm here on behalf of Retirement Benefits Institute, talking to federal employees and federal retirees about their TSP. Now, we've done videos in the past about how the TSP won't let your Roth convert. Check that one out. We've also talked about how the TSP won't let you fully diversify because it only has the 5 funds. Well, today the big drawback is how you take distributions from the TSP. A few years ago, the TSP updated how they did some things, and you are able to take distributions strictly from Roth TSP if you want to, or strictly from traditional TSP. So you do get to do that. But what you don't get to do is determine which fund it comes from. You can't say take all the money from the G fund, don't touch the C fund. You don't get to do that. Let's look at an example that just shows you how costly this can be. So for this example, let's call him Bill. Bill needs to take a $3,000 a month distribution every month from the TSP. Bill is set up to have 60% of his money in the C fund and 40% of his money in the G fund. This is a common mix that we see. So when he takes his $3,000 distribution, that means $1,800 is going to come from the C fund, $1,200 is going to come from the G fund every month. They sell shares that are needed to generate that much money every month. Well, you may be saying, what's the big deal? Well, let's talk about it. Right now, we're in 2020. Back in March is when the whole COVID-19 hit and the stock market dropped about 20%. In the month of March, Bill needed to sell and get the $3,000 worth of money for that month's distribution. He had to sell. 60% of the money came from the C fund, 40% from the G fund. Let's look at these numbers. So in March, the $1,200 a month that he needed to get from the G fund, you can see he had to sell 60 shares of G fund. To get the $1,800 a month that he needed from the C fund, he had to sell 54, almost 55 shares from the C fund. Now let's fast forward to June. By June, the stock market had come back. It was back to where it was. So in the month of June, to get his $3,000, he had to sell about 57 shares of G fund, not 60. And then in the C fund, he had to sell about 39 shares, not about 55 shares. Well, you still might be saying, what's the big difference? It's going to be huge. Let's dive down a little bit deeper. So with the G fund, you see how he sold 60 shares back in March. He only had to sell 57 shares in June. And that meant in March he was forced to sell about 3 extra shares, and it cost him $57. It's not a huge deal. Let's move on to the C fund. In the C fund, you can see in March he had to sell 55 shares of stock of the C fund to get the money he needed. But when you fast forward to June, he only had to sell about 39 shares. That means he was forced to sell 16 extra shares in the month of March as opposed to June. Those 16 extra shares, if he had not sold them and they got to come back in value, he would have $731 extra. The fact that the rules of the TSP caused him to sell when it was low means it cost him $731. Said another way, if you look in June, if he would have sold the same 55 shares like he did in March, he would have gotten an extra $731. The key here is when you are forced to sell the stock market position when it is low, it is not beneficial. This TSP rule cost Bill $731, and that's just for the month of March. I'm sure in April it cost him some, and then maybe May cost him some, and then eventually got back to where it was. And there's a simple fix to this. The TSP could just change the rules and allow you to dictate where you take your distribution from. You should be able to say, I want to take the entire distribution from the G fund. They don't let you do that, and there's no sign that they're going to change the rules to let you do that. So the next easiest fix is you can move your money out of the TSP into an IRA. In an IRA, you have complete control and flexibility to pick any investment you want, but also to determine where your distribution comes from. You can say, I only want my distribution to come from my conservative investment. That way I'm not forced to sell the stock market when it's low. Here's an example of a war chest. We kind of view the conservative money as your war chest, and that's where you take your distributions from. Then you have your stock market money, your aggressive money, and you shouldn't be forced to sell it while it's low. Another scenario might be that the stock market is doing amazingly well. It's really high, and maybe in your opinion, it's too high. You may want to switch your monthly distributions to come from all the stock market. While it is this high, I'd like to sell some of it. Maybe for the next 3 or 4 months, I would like all my distributions to come only from the stock market side so I can take advantage of the high prices. Either way, the TSP doesn't give you this flexibility. You have to take the money out pro rata. This is a problem. This is a big problem. So we've talked about in the other videos about how you can't Roth convert. That's a disadvantage. You can't get a bunch of different investment choices. You can't fully diversify. That's a problem. And to me, this is a big problem too. This was only 1 month that this person lost $731. Imagine in 2008 when the stock market dropped and it took about a year to come back. Imagine how much money people lost being forced to sell while the stock market was low. This is a huge deal. Now, most of the people we talk to that like the TSP and want to stay in the TSP, they give 2 reasons for it. The first one, they're used to it. It's what they've always known and they're just comfortable staying there. But the second reason everybody gives is that it's so cheap. And the fees for the TSP are cheap. But here's an example of their rules costing you money. It's kind of like death by 1,000 cuts. You don't see it, you don't feel it, but it's happening. Lots and lots of people, and it's totally fixable if you can move your money out into an IRA. So if you are over the age of 59 and a half, or if you have retired, whichever one comes sooner, you're eligible to move the money out into an IRA and you get complete flexibility and control of what you do with your money, the investments you pick, and more importantly, where you take your distributions from. So there are several disadvantages of being in the TSP. Ultimately, it's going to be up to you to determine, are these disadvantages so bad that you want to leave the TSP? How about in the comments, let us know if you knew of this rule, if this rule is important to you. Reach out to us. You can go to Retire Benefits Institute's website at retireinstitute.com. Reach out to us if you have questions. We'd love to hear from you. My name's Mel Stubbs. Talk to you next time.